Hey everyone, welcome to a new episode of In the Money with Amber Kanwar. Well, markets are back advancing. We had a little bit of a freak out last week, but what's really interesting is that even as the markets are at around record highs, sentiment is anything but frenzied. In fact, I like to look at the CNN Fear and Greed Index. I'm looking at it right now, and it is at fear. So how can it be that the markets are at record highs, but investors are feeling fearful? We're going to talk to Craig White about that. He manages about $2 billion. He's with Plena Wealth, which is part of Raymond James, one of our sponsors of the show. And he talks about this idea of having a core portfolio to ride out the volatility, but also sticking in some explore names. So we'll go through what's core and what's explore. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Craig White, thank you so much for joining the podcast.
Thanks very much, Amber. Pleasure to be with you today.
I just finished the book, The Anxious Generation, and so maybe anxiety is on my mind. But, we look at the markets ripping higher. They take a few moments to pause here and there. But it feels like every time we see the markets move up another 1%, another 2% in a day, it makes people anxious rather than celebratory. I checked the Fear Greed Index last week, and we were at fear, even with the markets at record highs.
Yeah, well, that's probably the question I think most investors are faced with so far in 2025. There's such a mix of cross currents that are occurring, and look no further than what's kind of transpired over the last week with some of the cracks potentially emerging within some of the regional banks and some defaults that we're seeing there, and you've had a little bit of reemergence of some geopolitics between China and the U.S. So here we are, as you said, as we're talking here this morning, and you've got U.S. equity markets once again, pretty much within a few points of an all-time high, despite, as you said, I would probably say a sentiment backdrop that is still mixed at best. And we see that within our client base, that a lot of the phone calls we face is how can we be here given the headwinds that we continue to face?
I mean, you mentioned the regional banking scare. Basically, a couple of borrowers were said to have, or a couple of lenders, I should say, said that a few borrowers were fraudulent. And so that they lent money that they're unlikely to get back. And this spooked particularly the regional banking sector, but this took down the whole banking sector in the U.S. Offsetting that was, earnings were coming through from a lot of these financials. And there were no signs that there were any more cockroaches beyond those 2 or 3 potential bad debts out there. Do you side with that, thinking that, that there are no cockroaches, that credit quality is generally still robust? Or is that one of those things that's giving you pause?
Well, take the term cockroaches. I think that's a Jamie Dimon term that has got a lot of attention over the weekend. And, as opposed to maybe cockroaches, maybe we kind of term it as a few ants that are kind of, that are running around here. I'm not surprised given coming out of COVID, we saw interest rates down to historical lows, and that's probably going to foster a lot of debt, which we've seen. I think it really comes down to the underwriting of a lot of those companies that are falling victim to some of these cracks that are emerging. Is it too early to tell? I'd probably say. Is it the only cockroach or ant? I'm going to probably say that's not. It probably brings up fears of 2023 when we went through SVB and some of the cracks that we saw emerge there. But I don't think we're at that point right now, Amber.
And that actually proved out to be a great buying opportunity, right? When Silicon Valley Bank had those issues, it really took down the sector. The question is, how do you hang on despite those anxieties? And you've got you alluded to kind of your team and your process taking emotion out of things, but you've got kind of a way that you structure the portfolio, core versus explore. I love a good rhyme, but maybe you could tell me a little bit about what that approach is.
Well, again, if we look at our core and explore positions, I'm going to say the bulk of our long-standing core positions represent about 80% of our portfolios. For Canadian investors, and I'd say even on the U.S. side, it's a lot of the familiar names, the Royal Banks of the world, the Walmarts, the J.P. Morgans. We tend to hold those, hopefully indefinitely, and as based on our process. What we do look at doing is, trimming around a position that we may feel has become overweight within a portfolio. And then, the other 20%, which would be the explore, tend to be more, I would say, cyclically oriented, or something that may see a tailwind that is prompting it to show some leadership at this time.
Is it riskier? Like when I think about explore, I think about, quantum stocks are taking off, or, this meme stock looks interesting right now. I assume maybe those aren't the kind of fly-by-night sort of investments you think are worth even exploring.
No, it's, here in Canada, I'd probably say it'd be a little bit more commodity oriented. We see a little bit of that in our portfolio. If I look at something more along the lines of technology, we tend to be a little bit more active with those names as well, not just in Canada, but in the US as well. And, we're always kind of tweaking our asset allocation around that, whether if we want to increase our equity weighting or vice versa, increase our fixed income weighting. But again, it's the main driving factors here, Amber, is really, what's happening economically, what's happening monetarily, and then as well where evaluations, what the technical picture looks like for us.
So let's answer some of those questions. What is happening economically? We're sort of grasping in the dark in the US because we're not getting all the data. In Canada, it seems soft. Monetary policy seems to be directionally easing, maybe not at the pace that markets like, and valuations are uncomfortable.
Yeah, all fair points. Rewind going back coming into 2025, and I think there was a common consensus that North America, and I would say global economies were likely tipping into recession. Well, fast forward, here we are, 10 and a half months later. That certainly hasn't played out. The first quarter of this year, we did see some scares, obviously, with tariffs and Liberation Day and what have you. And that was a spook that caused, a 15, 20% downdraft in equity markets. But through the thick of all of that, I would say that economic data continues to be pretty resilient across most fronts, in particular in the U.S. If you look at, some of the inflationary pressures that we face for 2022 all the way into 2024, a lot of those have abated. You're seeing core inflation rates running in around 3%, so still slightly elevated relative to central bank targets. But I would say that the path of least resistance is lower for inflationary pressures. I don't think we've seen third quarter data yet. That remains to be seen. But if we can run in and around GDP of 3.5%, given, what we know now, I'd say that's pretty healthy. And we haven't factored in yet the big conversation, what happens with AI and what that does for productivity. And if you see that boost in GDP output.
When I tease out kind of what you're saying, it sounds like you see it as more of a glass half full environment. But when we were chatting sort of as we were getting set up, you said something that sticks in my mind. You said, this is kind of a hated bull market. Why do you characterize it that way?
Well, I would say, look at a lot of the conversation right now is that we're in a bubble and what have you. I would say that the conversations that we have with our client base, and over the 20 plus years I've been at Raymond James, I've been lucky enough to build out a pretty strong network of fellow portfolio managers that we chat on a daily or weekly basis. And I'll tell you, Amber, the general consensus amongst the retail public is still a lot of hesitation. And excuse my French here, but I almost call it the no shit market, where if I was talking to someone and say, here we are with the S&P 500, the TSX, the Dow, the NASDAQ sitting at all-time highs, given the challenges or perceived challenges, people say, no shit, how the hell can we be there? So I dare say it's the most unloved bull market, but I think it's all part and parcel to a longer-term secular bull market that we've been in for a number of years. That's not without its share of corrections and periods of volatility, but that's the cycle of markets.
I wonder if that's bullish, the fact that not everybody's bullish.
Well, you referenced the fear and greed index, which again, I think takes into fund flows. If you look at positioning, if you look at overall sentiment, and again, I think the number one selling book right now in the New York Times, or one of the top 10, is The Story of 1929, written by Andrew Ross Sorkin, who's a brilliant author. He's a brilliant journalist like yourself. And, I would say that when you have that sort of messaging out there, I still think there's opportunity for upside here as we move into year end.
All right, well, let's find out where you find these opportunities. We've got tons of questions in the mailbag. Let's dive in. Okay, our first question in the mailbag, it's so funny. We're talking about people being pessimistic in the market and talking about AI bubbles. But more and more people are talking about a gold bubble, and the fact that gold maybe has run far ahead of itself. If the gains hold, the TSX Material Index will put in its best annual gain, on record since that index was created. What do you do with gold stocks here?
Well, again, I think they have to reference that if we're talking about the retail side of things, really what someone's allocation is in a portfolio, and really look at the reasons why they have gold as part of an allocation in their portfolio. It's no hidden secret that over the past, 6 months, in particular over the last 6 weeks, gold and the whole precious metal sector has garnered a lot of attention. Bubble, who knows? But go back to really kind of the 2 or 3 driving forces of why you've seen good performance within the sector and for bullion itself is, without a doubt, you've got a lot of central bank buying. That's always been the case. But as they look at broadening out their diversification of currencies and where they're allocating, it's kind of this de-dollarization of the US dollar, which, so far in 2025 has seen some weakness relative to other global currencies. So you've seen a pickup on central bank demand, and as I said, less reliance on the US dollar. I think you're starting to see not only the institutional side of things, but the retail investor jump in. And, it's funny because a year and a half ago, no one wanted to really talk about gold. And that's just kind of the rhythm and the rhyme of retail investors. It's they want to jump on something that is top of mind and what have you. So to answer your question, Amber, long story there, but I actually wrote a note on Friday to a few other portfolio managers, asked what they were doing. And our view is that we would look at taking some profits here on positions that have had, anywhere from a 50 to 100% run so far this year.
And go back to what? Like just take those profits, but that gold, might pull back a little bit. But do you still think it's going to remain in a structural bull market?
Yeah, I still think those same tailwinds are there. But again, it comes back to a function. Every individual investor is different. And, we always try to frame things of when I should be buying or selling and go back to our process, which is focused on core and explore. I would probably throw the precious metal sector into the explore silo of our portfolios. And again, if we've seen some good performance, rebalance those positions. But I don't think for most of our positions, and I would say our advice to a lot of retail clients is you don't necessarily need to be all in or all out with any individual position. And if a sector or a stock or a position is showing leadership, well, stick with that leadership. And as opposed to making an all-out call that, I need to be in or out, as I said, maybe you look at ratcheting up a stop loss on a position, 10% where you are, and then you kind of protect the downside there.
Let's shift gears to the financials, because certainly that's been top of mind with a lot of these U.S. banks reporting earnings. But the Canadian banks have had a really nice run. And one of the better performing stocks this year has been TD. We've got a question from James Gordon McLean on Instagram. Does TD still have room to run given that it's up 44%? I mean, talk about a comeback kid, right? You couldn't give it away last year when it was going through all of its anti-money laundering issues, and that proved to be the time to buy.
Yeah, absolutely. Let's not forget about the love for dividend-paying equities and cash flow generating securities here in Canada. That's just it's a Canadian trait that we have. And we see that, across our portfolios, and I'd say across most Canadian portfolios. With respect to TD Bank, banks are one of those categories that I would say are sectors that fall into the core silo within our process. TD Bank, we had known for a few years, but luckily and thankfully, we were accumulating shares of TD last fall. As you mentioned, Amber, they were plagued with a number of the anti-money laundering issues a few years previous to that. But if you kind of look at the last quarter, that the majority of banks, including TD, their announcements on earnings, it was, again, I would say across the board, it was pretty constructive. You look at whether if it's on the personal side, commercial side remains pretty strong. I think the big thing that we're seeing, not only on the Canadian banks, but you mentioned on the U.S. side, asset management and insurance side of thing is firing on all cylinders. That's a reflection of markets and portfolios and this movement over to fee-based solutions for banks and for money center banks. So TD Bank, I would be a holder of it. I would actually look to acquire Canadian banks on any sort of weakness. And I think the dividend on TD is still around that 3.7, 3.8%. I'd be a buyer of that name. And if anything, I had no problem accumulating it here.
I mean, they've got a turnaround. Turnaround stocks can be fabulous, if the turnaround is working. From those November lows, the stock is up about 50%. And I guess the question for investors is, has all that low-hanging fruit been picked? And now the work from here gets a little bit harder? Or do you think that there's still a lot that the new CEO can do?
Yeah, well, you continue to see, a quote-unquote restructuring across the Canadian banking landscape. Look what happened last week with Bank of Nova Scotia. I think they announced some layoffs as well. TD, you've seen that as well. That's a reflection of AI adoption. I think it's a big part of that. I think for the Canadian banks, what we need to be mindful of is what happens with the Canadian economy over the next few quarters, and in particular, what the exposure is to the Canadian mortgage market. Because, rewind 4 or 5 years ago, a lot of these mortgage originations were coming out of COVID, where you saw ultra low interest rates. And I'm going to say in my career, and I'd say for most people that are tuning into this podcast, that was generational lows for mortgage rates. Well, 2025, 2026, a lot of those mortgages are set to expire and mature, and they're going to be forced to renew, even with some rate cuts. I'm going to say at 100 to 200 basis points higher than where we were 4 or 5 years ago. So I think we got to be wary of that and what happens. But so far, provision for credit losses, they've actually trended lower, and you saw that again out of the U.S. banks last week.
I mean, that's the thing. So fine, you can say TD, and we're going to talk about Royal as well. They've got diversification into the U.S., but the domestic ones that are exposed to that story that you're talking about, those renewals, CIBC, your National Bank, they're also, near record highs. Do you think that the risk of that has been properly baked in, the renewals and the weakness in the Canadian economy? Because I have a tough time reconciling the weak economic data with exposed Canadian banks trading at record highs.
Fair question, Amber. And I think that probably is the ongoing question: is how can Canadian equities be where they are, given some of those headwinds we faced with the Canadian economy? It's, our labor market has seen more cracks than the U.S. Labor market. Immigration obviously has seen a number of headwinds. So, I would say that price action is price action, and I'm not going to argue with what the market is willing to pay for, solid bank earnings that we've seen. And let's not discount the fact that, the proliferation of ETFs that we've seen over the last, decade, 15, 20 years, as you continue to see systematic buying, whether that's through pension plans, RRSPs, and what have you, that just kind of feeds on itself. And with a number of these banks under the TSX listed 60 companies, you just continue to see fund flows moving into it. And I think the other catalyst that's driving this, as interest rates fall, the attractiveness of dividend paying equities only goes up. 2 years ago, we could offer a 5.5, almost 6% GIC to a Canadian client. That was a pretty easy solution in the face of 3.5, 4% dividend yields. Well, that's completely flipped in the past 18, 24 months, and I think that's a big catalyst driving these bank stocks as well.
Well, I also too the Canadian banks. They're not the entire lending market, and just anecdotally, and I'm sure you hear this too. They're not just giving out loans to anybody, right? There's been this huge growth in private lending, in part because the banks are not open. They're, the underwriting. So the debt that they're holding on to is different from all the debt that is available. Their standards have gotten quite a bit stricter over the last year, for sure.
Yeah, a few weeks ago, I had lunch with a close friend, and he manages and owns one of the larger mortgage brokerage companies here in the Okanagan. And you're exactly right. It still is a tough housing market here in Canada, and mortgage applications are getting tougher. The lending standards, as you said, Amber, they've only gotten more stringent over the last couple of years as well. But maybe that's not such a bad thing, because hopefully, and go back to our cockroach or ant story, hopefully that avoids the issues that you're starting to see percolate with some of the regional banks and secondary lenders south of the border.
Let's move on to still sticking with the banks, but we got a question on RBC. The question is, should I take some profits? This one coming from fan of the show, Young Guns on Instagram. So you've got RBC's got to deal with all those other issues, but then the biggest argument against RBC that I hear come up is valuation. It's an expensive stock, and Canadian banks have a limit of how high, what kind of multiple they'll trade at before they come back down. I wonder if that even applies to Royal anymore, because it's been expensive for some time.
I would argue justified and rightfully so. It's, I would put Royal Bank on the same playing field of a JP Morgan as one of the best well-managed financial institution money center banks globally. And I think for that reason, a company like RBC justifies that valuation, whether if it's 2-3 points higher than where it's historically traded over the last 10 years. I've actually continued to challenge that valuation argument, not just across Canadian banks and Royal Bank, but across the markets as a whole. Because I think what you're seeing is these high quality businesses, they do demand the premium. Look no further than, again, as I've mentioned with TD's most recent earnings, RBC's was firing on all cylinders as well. And they have the privilege of, the capital markets division, which arguably is the best here in Canada. And I would say it's, right in line again with a lot of those money center banks in the US. So is it expensive? Sure, I can make that argument, but I think it's justified. And, should someone, I think the question you just said, Amber, should I be taking profits? Well, I don't know this individual investor situation. I don't know what their cost base is. I don't know what the tax
for years. They've held it for
that.
years. So let's assume they're up. But yeah, you're right. The question on should I take profits, I guess, is less about their individual position and more just, you're sitting on a big gain on RBC and you have to assess, can that continue?
Remains to be seen. If I was to take a chart and sit with a client and kind of relay that out over more than a few weeks or a few months or a few quarters of earnings, it's pretty tough to bet against the performance of Canadian banks. So again, we own Royal Bank. I think it's actually our largest position on the Canadian banking side of things. We're not taking any profits right now. We'll let leadership show more leadership, and if anything, we'll look at rebalancing it because it's become an overweight position. But yeah, I'm pretty comfortable holding the stock here.
So we've talked about the gold stocks make up a big portion of our index, bank stocks, obviously, but we've also been talking about how Canadians love their dividends and their cash flow businesses. So let's talk telcos in that vein, because those are stocks that haven't been moving up and to the right for a while. Although the question that we have on Rogers, this one coming from Renata, do you like the telcos? What about Rogers specifically? Rogers reports this week and has got a little bit of wind under its sails. It has definitely perked up recently. Does Rogers stand apart from some of the other telcos? Are you looking at the sector if you're interested in dividends, or is it still in the penalty box for you?
I think the telcos are coming out of the penalty box. I think that's the right term, Amber. It's, for a few years, it's been an extremely challenging environment for telcos. The competitive landscape amongst, whether it's the 3 or 4 big players, that being BCE, TELUS, Rogers, Quebecor, it really is probably one of the most challenging, most competitive landscapes that you've seen. If you look at average revenue per user, they're all trying to battle to see who can gain market share on that. And as we know, for years, telcos have been plagued with high debt and leverage ratios that the market has been or was uncomfortable with. 2022 to 2024, a massively underperforming area of the Canadian market that now on the backside of declining interest rates, and I think some restructuring that you've seen amongst the banks. Look at BCE with the cut that they've seen in their dividend. I'm more inclined to say that you're starting to see a better pathway ahead for these telcos. And we were actually acquiring within our portfolio, which was specific to Rogers. We were a buyer of Rogers. We have been throughout 2025 here. And, their recent announcement taking over Maple Leaf Sports and Entertainment from BCE. And I think they're about a 76% owner of Maple Leaf now. I don't know if they specifically report those numbers, how they're doing. You in Toronto, you're probably inundated with Blue Jays and what's happening there. But I think that's only accretive to the bottom line of a company like Rogers.
Yeah, I think their media unit is poised to show some big growth this quarter when they report. You mentioned BCE. Is that a name that you're also adding? They just had their first investor day in a decade, a stock that has languished. They cut their dividend, to your point, but now they're trying to reset expectations. They've laid out financial targets. They've committed to pay out, I think it's 45 to 55% of their cash flow and dividends, just to put them on a bit more of a sustainable footing. And they say, we're going to grow again.
Interesting you bring that up. That came up amongst our portfolio management team. I think it was last week or the week before. I haven't had a chance to review their investor day, but as you said, I think that's their first. BC, without a doubt, they're going through this quote unquote restructuring, and they're trying to shore up their balance sheet. And as I said, you saw that through the dividend cut. That's not a name that that we've added to portfolios at this point. We do own TELUS and Rogers. I'd probably like to see another quarter or two out of BCE to see that, a lot of these headwinds are behind them, and the market will start to recognize that. So I think they're checking the boxes to a path of righting the ship, but I think it's still a bit too early on a name like BCE.
When Canada was when immigration numbers were soaring in Canada, it really lifted those telcos. Now that has slowed, that's also been part of what's put them back in the penalty box. But, in all my years of tracking the telcos, immigration was never a real catalyst. It became one because all of a sudden it was. But eventually, does the conversation become less about immigration driving, signups, basically, and new subscriber growth?
Well, that has been a huge contributing factor, was the increase in their subscriber base, and without it, I think that's going to have an impact on it. And that's really what all these telcos are fending for, is the subscriber base. And it's pretty tough. I'll speak for myself. I'm a Rogers user. It's pretty tough for me to go out and just change, who my provider is, unless something really upsets me, and that's a personal decision. So you don't really see a lot of transgression across the 3 or 4 different telco providers. So I'm going to say, for the most part, the subscriber base is relatively sticky. The competitive landscape, as I mentioned, whether if that's cost savings or special incentives that they provide. But I'm going to say it's pretty sticky business for all 3 or 4 of them.
Let's talk about some U.S. stocks. And I'm curious if you own any of these. We've got a question from John on X. Is Netflix still a buy? What do you think of the valuation? Netflix, I think it does report this week, and there's a lot of I don't know what your household is like, but there's a lot of excitement around K-pop Demon Hunters. It's so funny. It's been on in our house like probably 300 times a week, I think. And my husband still doesn't know the plot. And I'm like, how is that possible? It's on all the time. We're all going as demon hunters for Halloween. But, Netflix, do you expect it to benefit from that? Is that a stock that you're constructive on?
It's funny you bring up K-pop. Ironically, over the weekend, I was scrolling through Netflix. Yes, we are a subscriber to Netflix. I'm going to say most households that have young children, which I do. Mm-hmm. And K-pop came up, and I had never heard of it. And my daughter was just flabbergasted that I had not heard of it. That I now think that K-pop is the largest viewed. Is it a movie or
a soundtrack? Program? It's both. It's. I think it's record for streams, like 325 million streams. Yeah. Plus the songs like "Golden," which is a real ballad. I listen to that on my own in the car. Is topping the Billboard chart. So like it kind of did both.
Well, let's go back to this ongoing debate of, streaming wars. We've seen that, we talked to the telcos and this cord cutting that's been a theme for, 5-10 years right now. And talk about a competitive market. Well, in the US, globally, that is probably one of the most competitive markets that we've seen is, who's trying to gain market share, whether if that's YouTube TV, Disney, Amazon, Netflix here, 350 million views of K-pop, 325 million. They have, I think, about an 8-9% market share, largest being YouTube, over 300 million subscribers globally, I believe. And if you look at the content battle that each of these streaming services are looking at trying to attract, whether that's K-pop or Squid Games, Stranger Things is a big one. I think that's where you continue to see a lot of the investment across these providers, in particular Netflix. And I think you're going to see that, as you mentioned, Amber, in the next couple of days. I think they report, maybe it's tomorrow or Wednesday, what that looks like on their average viewership. And, are you seeing their 300 plus million subscribers spending more time on the platform? In addition to what does their subscriber base look like? And I don't know if it's Netflix, but I know a lot of these large cap companies have removed some of their guidance, and I think Disney was not issuing their subscriber base or new issues.
Yeah.
So
Netflix is the same.
I think that's the case with Netflix. So I think that remains to be seen.
Do you own
one
it?
maybe
Do you own
underappreciated
Netflix?
area I think where Netflix is stepping in is on sports streaming. And if you recall some of the boxing events and UFC events that Netflix has participated in, I think look for that over the next number of quarters. I wouldn't be surprised if you hear something coming out of their upcoming earnings announcement that's going to be a bit of their focus. Not necessarily long-term deals with NHL or MLB TV, but special one-off events that's probably going to generate a lot of attention and views as well.
So do you own it? Do you like it here?
No, we don't own it. If I was looking at the price performance of the stock, I think it's more or less consolidated for the last 3 or 4 months. If earnings are good, I'd be a buyer of it. If I own the position as well, depending again on an individual's situation and exposure to the name, maybe even look at adding to it if it sees some good earnings and it can break out of this trading range that it has been in. On the downside, I think the kind of the 200-day moving average, if I was to use some of our technical overlays, I think it's within 5-10% of where we are right now. If it were to break that moving average, I would probably look at maybe harvesting a bit of gains. But let's see what happens over the next couple of days with earnings.
Tesla also reports this week. We got a question from Ruth. I'm torn on Tesla. It's up 100% this year. Would you recommend buying now or when it has sold off? It's so funny that it's up that amount this year, because I'm going to just do it quickly on my chart. It's also had a 50% drawdown this year. Maybe, it's had a 150% drawdown this year, but that's not unusual for it to have a couple of those in any given year.
Well, whether it's individual shares such as Tesla or equity markets, drawdowns again are part of the cycle. I think everybody's seen the average intra-year drawdown over the last 30, 40 years, that it amounts to 14% you see from peak to trough at any given time throughout a calendar year. For a high beta name like Tesla, it has been certainly, in my opinion, a news-driven stock over the last, 8-9 months. I think some of the challenges that you saw that perpetrated that 50% drawdown was probably a reflection of some finger pointing at Elon himself. I think the polar views that we continue to see amongst the Trump administration and Elon's involvement with DOJA, the Department of Government Efficiency. I think that created more headwinds probably for Tesla than a lot of the Tesla shareholders envisioned.
Don't you think it's too messy of a stock? Like there's too much of that like interpersonal drama. And then, like robo-taxis, I get it, and fully self-driving, but it's still a company that's, what are we getting excited about? We're getting excited about 3%, 4% sales growth in the coming quarter.
Yeah, and I think that's an extremely valid point, Amber, because I think even the last quarter over quarter, you saw a decline in their sales, and without a doubt, the sales for Tesla has plateaued. that was all the rage 3, 4, 5 years ago. I know that amongst our inner circle of friends and what have you, we went from no Tesla drivers to, I can probably say 30, 40% of the people we know were driving Teslas. I think what Tesla needs is probably a new product cycle, kind of like what Apple has gone through over the last couple of years. I think even they've announced kind of a quote unquote cheaper version of some of their models to attract the lower end. I dare say lower end, but lower end part of the auto market. But yeah, it's tough to get too excited about this. Tesla is the type of name that, again, it can be one announcement away from seeing a 10, 15, 20% pop or vice versa. You continue to see weakening trend for sales. I would be very cautious on the stock here.
This question on Intel, I'm curious if this is a name you explore from Amit. It appears Intel's making a comeback with NVIDIA and the Trump administration taking a stake in the business. Intel is up 90% so far in 2025. And this is like one of the few times that, I love a stock at a 52-week low. I love a broken stock, and it doesn't always work out for me in a bull market. And it's worked out for me on Intel. And so the question is, like, should you just take your chips and run? Because Intel is not it hasn't been a success story, especially when it comes to innovation.
No, you're exactly right. To answer your question, we don't own Intel in our portfolios. I think it really comes around to this circular revenue generation that you've seen amongst this AI theme. And I'll certainly admit I'm not the AI expert. I try to educate myself on this to try to see what's happening within that sector, whether if it's in NVIDIA investing in OpenAI, the government, as you said, investing in the likes of Intel. I will say that I don't know where we are in the quote unquote 9-inning ball game for this AI theme and the build out that you're going to continue to see on microchips in particular with Intel. But I've listened to some pretty smart people, including Jensen Huang from NVIDIA, and they're a firm believer that we really are in the early stages of this build out. So for all these microchip names, NVIDIA, Broadcom, Intel, I still think that you may see some surprise to the upside as well, because the capital, we've all heard about the capital expenses that are going into this, and we're not talking, a couple $100 billion. Is viewed to be, over $1 trillion over the next 5 to 10 years. And if that's the case, what does that do to bottom line earnings for a lot of these companies? So we don't own Intel. I know that's kind of a bit of a vague answer there, Amber, but I'm mindful of where these valuations are in the AI side of things, but I think you still got to give the benefit of the doubt here.
Our last question in the mailbag before we go to your top ideas, like the polar opposite of a Mag 7 and the AI trade, is on Pool Corp. And this is a name, if it's not on your radar, it's on Warren Buffett's radar. He's been buying. He's increased his stake in 2025. And as the name suggests, they're a pool supplier. They supply things to people who build pools. And the stock really has languished. It's bouncing around multi-year lows. And Scott has a question. If Buffett is buying Pool Corp, is it a sign that I should too?
The good old Buffett question. Yeah. I'll admit I'm not too familiar with the Pool Corp name. Let's frame it in the context of Buffett. There's the Oracle of Omaha. Whenever he's a buyer or seller of any position, that generates a lot of attention. And I'll tell you, we're inundated with that, with Buffett and what he's been doing within his portfolios. And I still think his cash hoard is upwards of $350 billion. And some people view that as, he's fearful of the market or he's hesitant. And he's even come out and said he's challenged to find good opportunities. But I would say that, whether if it's Buffett or let's just call it Berkshire Hathaway in general, they follow an investment process much like our team does. And I got to think they do deep-rooted fundamental research on any name that they're considering buying or selling. And they look at, why that could be accretive and make sense within their portfolio. The reason I think pool companies got a lot of attraction is because Buffett has been a buyer. I think from what I've heard, they've increased their weighting to about 10% of the value of Pool Corp, which is, I think it's about $1 billion company. So in the grand scheme of thing, or maybe a $10 billion company, I don't know, but in the grand scheme of thing, it probably amongst the Berkshire's total holding, it's probably a small position, but
I just looked it up. Do you want to know?
Sure.
It's
enlighten me.
0.4% of their portfolio. And to put that, like Apple is 22%.
Yeah,
so Pool could disappear and it would be fine for them. It would be a rounding error.
Look at the attention that generated when Berkshire Hathaway, it's not Buffett, when Berkshire Hathaway was a seller of Apple stock, a lot of people were saying, well, that's the end of the company. Well, I think here we are today, Amber speaking, and I think Apple is trading at a new all-time high and continues to see a number of price revisions to the upside. So circle that back to Buffett and Berkshire. Trust the process that they have, and I expect that they've done their work and due diligence.
All right, let's go into the stocks that you've done your work and due diligence on. Let's get into your pro picks. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay. Love these picks. First of all, these are kind of down names. So already, that's my toxic trait is I love stocks that aren't participating in the market rally to see if there's an opportunity. And I'm down on a couple of them. So I'd love to know if there's a silver lining. Your first one is Nike. Why do you like Nike here?
Well, so I'll say that Nike is a name in full disclosure that we have started to build a position in within our portfolio. And the reason being is, why would someone want to own Nike, given the challenges that the company and the stock price has been faced with over the past number of years? And I would say that you look at a price chart of Nike and it's been pretty ugly, but, circle back to Nike, arguably one of the most globally recognized brands out there, whether if it's the Jordan lineup, the relationships with a number of other sports stars, such as Serena Williams, Ronaldo, who's got a big capture in the European markets. But what I think you've seen is a number of the challenges that Nike had faced for the past, 2, 3, 4, 5 years, such as a massive inventory buildup. And I think they kind of got a little bit off track with where their focus is with some of their core lineup and some of their core products. And I think what you're seeing is this kind of resurgence of the stock and a new structure. I think the new strategy is called Move Now or something like that, where they're really focusing on what the core is of Nike's business. They continue to work through a lot of their oversupply and inventories and kind of refurbish their relationships with a lot of their wholesalers. And as I said, focus on their core business. I think the most recent quarter that we saw coming out in September was the first year that you actually saw year-over-year improvement on earnings. Now, that's just kind of maybe a small green shoot, to use that term that you've seen with Nike, but I wouldn't be surprised that over the next couple of quarters, you continue to see some earnings improvement on that side of things. And I would consider it a turnaround play. This isn't a contrarian call for us. I think you're starting to see a fundamental change for the company and, again, a refocus on what they do best.
And, some people say, I'm not asking a stock to go where it hasn't been before. This is a stock trading at $68 a share. 2021, was above 160. As you kind of do the math, does it get back to those levels? Are you asking it to go back there? Or do you think even if it goes back to, 100 where it was like in 2024, that's kind of a win?
Well, ultimately, yeah, we'd love to see the stock price at 100 or retest new, all-time highs. That will prove our conviction on the stock was correct. I think it's a name that we're looking at accumulating. It's not a full position for us in our portfolios, but I think it's a name that you can start accumulating and look to add to it if you see confirmation and the market is reacting well to it. So, yeah, it's still got some of the headwinds. I don't think that's changed. What does the consumer do if we continue to see if we see some weakness amongst the consumer? Well, hey, it's probably going to be a bit more of a challenging market for a company like Nike, and I'd argue for all consumer discretionary names. So I think you need to be a bit patient with the name, but we have no problem accumulating it here, Amber.
Okay, let's talk about your second idea, which is Intact Financial. And people really love Intact, and they love this sector in general. And yet, it's kind of trading at the lowest level since February. It's down about 20% from its peak a couple of months ago. Before you tell us why you like it, help explain why has Intact suddenly drifted lower?
Yeah, I think the main driver is coming out of their earnings, which I think came out in June or July of this year. And despite some pretty good numbers across the board, and I think they saw some weakness in Europe, but the Canadian P&C market was pretty solid. The U.S. market, I'm going to say, is kind of it's chugging along. It's marginally improving, but I think bottom line, what you saw, Amber, is the market is a bit hesitant on forward guidance and what the outlook is for the insurance company itself. So, that's, I think, is probably 90% of the structural issues that has caused the stock to trade where it's at today. I think maybe last week, more recently, you saw a bit of a blowback on some weakness across the broader insurance sector in the U.S. And I think that filtered in to some hesitancy in the Canadian insurance side as well.
So now, why do you like it? What do you see as the opportunity here going forward?
We've owned the company for, probably more than a decade now. I dare call it a utility, but the insurance business is a pretty static business where, as I mentioned, the Canadian market, you've kind of seen mid to high single digit growth rates on the P&C side of things. Their underwriting remains extremely strong with profits. I think year over year up kind of 14, 15%. As I said, the international segment continues to see some tailwinds as well. And I just really think they are a global leader on the insurance side of things. And probably steered by some of the strongest management within the insurance side of things here in Canada and globally. So it's pretty tough to bet against the company itself. I would be an accumulator of the stock here at these price, and I would probably look at doing that within our portfolios as well.
You're right that the UK kind of proved to be a bit of an issue last quarter, even though headline results were decent. UK, I guess it's a growing piece of the pie, but it's still majority driven by what's going on in Canada.
Yeah. At the end of the day, the team at Intact, they continue to execute on their strategy. If they saw a bit of weakness in one quarter, what have you, I don't think that's a reason to run for the exits for, again, a company that's well managed, that executes on their strategy, and they'll find ways. If they see weakness in the U.S. or the international markets, they'll find a way to right that ship as well. So again, I've no issues, as I said, buying the stock at these levels.
You've got your third pick in Tourmaline, and that's super. I wanted to hear your reasons why. And we just interviewed Mike Rose, an in-depth interview last week. So if people hear what you say about Tourmaline and want to learn more, we've got that interview up on our page right now. Talk to me about why you like Tourmaline, another stock that is languishing.
Yeah. No, I actually, in all fairness, I did see that you had interviewed Mike Rose, and ironically, we had started building a position in Tourmaline, I think about 2 weeks ago. So before the interview, so maybe our timing's pretty accurate here, but I think Tourmaline, without a doubt, probably the preeminent leader within the Canadian natural gas landscape here in Canada. Largest producer of natural gas, and I think they're the third or fourth largest midstream operator here in Canada. What we like about the company, first and foremost, management. I'm going to say they're probably the bench strength of their management team is best in class here in Canada. And you've seen that, with a lot of the mergers and acquisitions that they've seen over the last number of years. Maybe the market's been a bit hesitant on the stock, which is why it's probably traded sideways for the better part of 2 to 3 years. But you look at all of these strategic tack-ons that Tourmaline has seen. At the end of the day, it's our belief that it's only accretive to the stock. And you look at their plans on this Northeast British Columbia build out. Their production expectations, I believe, over the next 3, 4, 5 years, takes it from 600,000 billion feet equivalent a day to where they are. I think a 20, 30, 40% increase on that. So the company itself is a free cash flow generator. They do offer a quarterly dividend, and I think they do offer a special dividend, which is on a one-off basis here and there. But I just think the backdrop for natural gas for this company in particular, and the electrification and the demand that you're seeing from AI and these data center buildouts, I think that's only a massive benefit to not only Tourmaline, but I think the Canadian natural gas sector.
Well, and he spoke to all of those issues. In fact, I asked him, when are nat gas prices going to get better? And he's like, in 4 weeks. And he was being serious because he said winter is coming. So they've got winter. They've got some offtake, with LNG Canada going. So that allows Tourmaline to kind of come in and fill in that demand that from the supply that went elsewhere because of LNG Canada. And he talked pretty candidly about the spending plans, which I think made people nervous. Right? They were worried about, well, then does that mean cash flow isn't coming back to me? You mentioned those dividends, and it comes full circle. Canadians do love their dividends and their payouts, and they want to know that's growing.
Yeah, I'll default to the team there. I don't think it's wise to second guess the management decisions of Mike and his team. Is there hesitancy or fear of what they're doing? I don't share those same thoughts whatsoever. I have full faith in what the management team is doing. And I think at the end of the day, you're going to see that. You got to be patient, and you look at 27, 28 into 2030, what that does for top line revenue and bottom line earnings. I think you want to own this company. And as I said, if you continue to see this massive AI build out, I think it's tough to challenge yourself to see how that can't be beneficial to the likes of Tourmaline, as I said.
Craig, it's been an absolute pleasure. Thank you so much for taking the time and sharing all of your insights with us.
Pleasure, Amber. It's a great hour with you, and we appreciate spending the time with you as well.
That's Craig White joining me of Raymond James, Plena Wealth of Raymond James. Don't miss our next episode. We've got Swansea Karshi coming on the show. She's with Scotia. We'll catch you on the next episode.